Oh, so you got me during my coffee hour. But without further ado, let's get this show. Today we're going to be talking about, you guessed it, market structure. Market structure. Yeah. So what is market structure? Well, it's not something I can explain verbally, although I can try, but it's much better to show you guys on the screen. So without further ado, let's jump in the screen.
What is the market structure? Well, essentially, the market structure is used to explain the behavior of the market. It's the first thing that you should look out for before drawing up your setups or lines. Okay, so we have two structures in this market. We have the impulsive structure and the correction structure. Now, these two structures make up the market. It shows how price moves. Like I said, it explains the behavior of the market. So when the market moves in a corrective phase, it gives us an indication of what is to happen next. So let's start with the corrective phase, and I'll give you a quick example. Here we have, let me look for a corrective phase. Okay, I found one. Here's a corrective phase. If we zoom in, we'll see it real clear. So this is a corrective phase. Okay. And let me quickly define what corrective means. Okay, so the corrective phase, in other words, is choppy or ranging, or stagnant or consolidation. So they could use these to determine the corrective phase. That says that the market has no clear sense of direction and it is just going up and down. So what you could do is, to trade the corrective phase, you would use support and resistance to trade it. So as we zoom in, you could see that it's not going, there's no clear direction. Okay, it just went up, down, up, down. And like I said earlier, if you had taken note, that the corrective phase is also a means of reversal. So like we are seeing right here, price went all the way up, corrected, then boom, it reversed. So that's a reversal pattern. The corrective phase is a reversal pattern. Alright, now enough of that. Let's look into the impulsive phase, or in other words, jumping the gun, precipitate, or gone off the deep end. Betting short, up and down. In forex terms, impulsive phase. So okay, we're looking for an impulsive phase. Well, it's clear. Okay, here's an impulsive phase right here. An impulsive phase is when the market goes like this, straight down. Okay, and that way you'll be able to use it to draw up your lines. Okay, so now this is an impulsive phase altogether, and here's the impulses within this impulsive phase. Okay, so now that's the impulsive phase. And how do you take this trade? Well, essentially, once you have drawn up your lines like this, and you've seen that the market has gone from here to here to here to here to here, the next thing you'll be expecting is a buy once it's at the bottom. So let's say I had placed my buy like this. Okay, you can see that I would have been in profit, and I would have been in profit all the way. Okay, so that's how you could utilize the structures. It's very easy. It's freaking easy. So that is pretty much everything on the impulsive phase. Just so you should know, a good knowledge of this lets you to know when to enter the trade, when to exit the trade, and when to stay away from the trade. And as you develop your own sense of the markets, you will begin to see it clearly and understand. So like I said, let me just give you a quick brief here. The market moves in two phases. So if we draw the overall trend, we would see it clearly that patterns happen within patterns. Once you see it, you can't unsee it. So that is market structure, and I'll see you guys in the next one.
So guys, I hope you have a basic understanding of market structure. And if you like this video, you can leave a like and a comment saying you love the video. But if you don't want to do that, I don't care. You can just put a heart down below.